All right, so here we are in Chapter 10, and Chapter 10 is all about dispositions of partnership interests and how we deal with distributions from partnerships. All right, so the first thing we have to talk about is kind of some basics of the sale of partnership interests. So we have several seller issues, right? And we have to calculate the amount and the character of the gain and loss. Okay, so that's a big deal. And so we need to look at the selling partner, and they're going to determine their gain or loss as the difference between the amount realized and their outside basis in the partnership. Okay. The other thing we have to talk about is this concept of hot assets and what those are. Okay, so I'm going to rearrange these just a little bit here. Okay, and so hot assets are going to cause us to have ordinary gain. Okay, and so what is a hot asset? A hot asset is an unrealized receivable or inventory. So hot assets are unrealized receivables and inventory. Okay, and so as I said, if a partnership has hot assets, this is going to cause the selling partner to have ordinary gain. And so that brings us to this calculation here. Okay, and so it's really a three-step process because you have to determine the amount of the gain or loss as well as the character. Okay, and so the amount of the gain or loss comes here, and this is, your basic gain calculation, right? Gain or loss calculation. It's the amount realized minus their outside basis. Okay, then you have to figure out their share of gain or loss from hot assets. Okay, and essentially this is a theoretical calculation because we're assuming that the partnership sold these hot assets at fair market value, and so that's going to represent, that's an ordinary portion of the gain or loss. All right, and then to figure out your gain or loss, you're going to take your total gain or loss from step one and subtract this hot asset portion that you calculate in step two, and that is going to give you your overall gain and loss. Okay. Okay, so one of the big issues with partnerships is called the varying interest rule. And you essentially have a couple of different ways in which the partnership interest can vary. All right, so what happens when you receive a distribution or sell a portion of your partnership interest? Well, if you receive a distribution, then your interest is going to decrease. Same thing as if you sell all or a portion of your partnership interest. And so there are two different methods for allocating the income or loss to partners when their interests change. Okay, and that allows you can prorate the income or loss to the partners with varying interests, or you can do an interim closing of the partnership books. Now also, I'm going to write this down over here, and I'm going to change the color of my pen a little bit. If partners contribute property or cash, then their interest increases. So increases partnership interest. Okay. And then also we have to talk a little bit about sale transactions. So I'm going to slide up a little bit more. So the new investors outside basis will be equal to the cost. And then also remember that when you purchase a partnership interest, if you have a share of the liabilities, then that share of liabilities is also going to increase your outside basis. Okay. All right. So with a partnership, we have two kinds of distributions. We have operating distributions and we have liquidating distributions. Okay. We are going to be primarily focused on operating distributions. Okay. Typically, they're usually paid to distribute business profits to the partners, but they can also reduce a partner's ownership. All right. And then you have two basic types of operating distributions. You have ones that include money only. Okay. And then you have ones that have property other than money. Okay. So let's talk about these two categories. All right, so operating distributions with money only. Let's talk about those first. Okay, so with money only, so generally, the partnership does not recognize any gain or loss, and the partner does not recognize any gain or loss. There is, of course, one exception. And the exception is if the money distributed is greater than outside basis. Okay. Then you're going to recognize a gain. The partner. For that amount that the distribution exceeded outside basis. Okay. From a partnership's perspective, the partnership does not change the basis in its remaining assets. Okay. And the partner will never recognize a loss from an operating distribution. Okay, so that's important. Okay, so now let's talk about operating distributions that include property other than money. All right, so I'm going to slide this up a bit and I'm going to change colors. Okay, and so now what you have is partners are going to have to reallocate their outside basis to those distributing assets. Okay, so partners will have to allocate outside basis between distributed assets and their remaining partnership interest. Okay, so your partnership distributes property to you, okay, and you're going to have to determine how your outside basis gets distributed between those assets now and your continuing partnership interest. Because remember, anytime you get a distribution from your partnership, your outside basis is going to decrease. Okay, and so the partners take carryover basis in any property received in the distribution. Okay, so whatever the partnership's basis was in that property that has been distributed, now the partner has that carryover basis. Okay, there is definitely an order in which you're going to allocate outside basis to the basis of the distributed assets. Okay, so there's an order of allocation. All right, and so first, you're going to allocate your outside basis to any money received. Okay, then to property as carryover basis. Okay, and then any remaining outside basis is now just your your basis in the continuing partnership interest. Now, it could happen that the partnership distributes property other than money with basis that exceeds your outside basis. Okay? In that situation, then your remaining outside basis is reduced to 0. Okay? So if basis in distributed property is greater than outside basis, then the outside basis is reduced to 0. Okay? All right, so now we have the issue of liquidating distributions. Okay? And so basically, what are our issues? Well, they're kind of the same as our issues always are. All right? We have to determine whether the terminating partner recognizes a gain or loss, and we have to figure out how we're reallocating the outside basis to those distributed assets. Okay? Because remember, a liquidating distribution means that you are discontinuing your partnership interest. Okay? Kind of by definition. Okay? And so we got to figure out whether that partner is recognizing a gain or loss, and then we have to figure out how to reallocate that whole outside basis to whatever they received in that distribution. Okay? Typically, all right, and again, generally speaking, partners and partnerships do not recognize gains or losses in these liquidating distributions. But of course, there is an exception. All right, so I'm going to move things around here and let's talk about the exception. All right, so again, remember this is liquidating distributions, okay? And so here are our exceptions. So a partner is going to recognize a gain, all right? When the partnership distributes money, this includes debt relief and the amount exceeds the partner's outside basis. So the partner will recognize a gain or debt relief that exceeds the partner's outside basis. Okay? So that's when you would recognize a gain. Now, the partner will recognize a loss okay, when two conditions are met. All right, and so those two conditions are the distribution consists of only cash and hot assets. And remember, cash does include debt relief, okay? And the partner's outside basis exceeds the sum of the distributed assets. All right, so we talked about gain or loss. And while gain or loss on a liquidating distribution is an issue, and it's a big issue, it's not the only issue that we have to be concerned about. So I'm going to rearrange my slide just a bit, okay, because we have a couple of other issues we have to talk about. So the first one is, okay, so now you've distributed all this property, right? So whoops, that is not how you spell basis. Now we have to determine for the partner now, or the person who is no longer a partner, who has all these assets that were just distributed to them, what is the basis? So what's the basis in this distributed property? How do we figure that out? So the objective is to allocate the partner's outside basis, right, to the assets that they just received. So, because the partner had an outside basis in their partnership interest, now they have all these assets. Okay, so you've got to allocate those. And so essentially, this allocation is dependent on two things. The first, the partnership's basis in distributed assets relative to the partner's outside basis. The partnership's basis. I don't want to shortcut what I'm writing. Okay, so that's the first thing. And then the other thing is the type of property distributed. Okay, and so whether it's money, or hot assets, or other property. Okay, so you got to allocate the entire outside basis of that former partner to the newly distributed assets. Okay, and then What we also have to do is we have to consider the character and holding period of the distributed assets. So it's really it's always the same problems, right? Are we recognizing a gain or loss? What are the basis of the assets that we're talking about, right? And then what's the character and holding period related to those assets, okay? So typically, the character stays the same for the partner as it was for the partnership, okay? I'm going to scroll up here a bit. Okay. However, or I guess not however, inventory and we'll call it the taint because it's not a good thing. Inventory retains the taint of ordinary income for 5 years. All right. So if the partnership distributes inventory to the partner, that inventory is considered ordinary income. The sale of that inventory would generate ordinary income for 5 years after the distribution. So for things other than inventory, the partner's holding period includes the partnership's holding period. And this makes sense, right? If we're getting carryover basis typically, and if the character remains the same, then it makes sense that the holding period would be would carry over as well. Okay, remember that the notable exception to this is inventory. Okay. Now, there is one additional nuance that we need to talk about, and so I'm going to scroll up a little bit. Okay, and so this is true for both operating and liquidating distributions. Okay, so they can be disproportionate. I think that's spelled right, disproportionate. Okay, and what that means is they can change the partner's relative ownership of hot assets. Okay, so in order In order to prevent partners from converting what would be ordinary income into capital gains, okay, so in order to prevent a conversion from ordinary income to capital gains, a partner must treat a portion of the distribution as a sale or exchange, which results in gain or loss recognition. And again, this deals with hot assets. Okay, so anytime there are hot assets in the mix, you need to pay particular attention. All right, so let me finish what I was writing. So the partner must treat which results in recognition of gain or loss. Okay, so the book gives us these great little charts with the scenarios, with the potential scenarios. Okay, so these are all of the alternative scenarios for determining basis in distributed property. Now, remember, this is liquidating distributions. Okay, and so here you go. If a partner's outside basis is greater than the inside basis, you have these scenarios, okay? If a partner's outside basis is less than the inside basis, you have those scenarios, okay? We are not going to go through all of these scenarios in detail, but we are going to touch on a couple, okay? So let's go to our first one, okay? All right, so the first thing I'm going to do is resize this a little bit, all right? And let's talk about Greg. So this is scenario 1, all right? So what does scenario 1 mean? What scenario 1 means is that the partner's outside basis, all right, is greater than the inside basis, right, of what he's receiving, okay, and he's receiving money and hot assets, okay? So as soon as you see that he is receiving hot assets, you should automatically start thinking about whether he's going to have to recognize a gain or loss, okay? Because hot assets are one of those triggers. All right, so I'm going to rearrange here a little bit. All right. All right, so there's our situation, and the question is, will Greg recognize a gain or loss? Okay, and again, we're looking at those hot assets specifically to help us understand. Okay, so will Greg recognize a gain or loss? All right, well, first, let's take a look and see what we've got going on. So he's got an outside basis of $334,000, and that outside basis includes his share of liabilities. So we're going to take his liabilities out. Okay. And then what is he getting in his distribution? He is receiving $159,000 of cash, and he's receiving $49,000 of fair market value and basis, $49,000 of inventory. So this is cash, and this is inventory. And so what does that leave us with? So that leaves us with a $60,000 difference. So what does that mean? So what that means is his outside basis, right, was larger than what he received from the partnership, from the distribution. So Greg is going to have a $60,000 loss, and he is going to recognize that. Okay, now, what is the character of that loss? Okay, so now we have to think about what would be, I guess, what would the tax code want to have happen? Okay, so this is his partnership interest. If he were to sell just his partnership interest, right, he would have experienced a capital loss. All right, and so even though we've got these hot assets in here, his loss is going to be a capital loss. Okay. Oops. Because the tax code is not in favor of turning a capital loss into an ordinary loss. All right, so remember that he got inventory distributed to him, okay? So if he sells that inventory within 5 years, it will generate ordinary income. After 5 years, it will generate a capital gain. Okay, so this, so we're still in liquidating distributions. And if you're following along in the PowerPoint that I posted on Canvas, you'll notice that we just did scenario 1, and then this is a slide relating to scenario 2, and there's also scenarios 3, 4, and 5. And those have to do with kind of the different relationships between what the distribution is relative to what the partner's outside basis is, right? So the relationship between the outside basis and the inside basis of the assets that are being distributed, okay? So I am not going to go through the details of scenarios 2, 3, 4, and 5. In your PowerPoint on Canvas, there's an extended example for scenario 2, okay? And it steps through the calculations related to scenario 2, okay? So we are going to kind of gloss over scenarios 2, 3, 4, and 5 from a discussion and a calculation perspective, okay? So this is scenario 2, all right? And so what is the situation? You've got your outside basis is greater than the inside basis of the assets that are distributed, okay? So what are the big ticket items here, okay? So you are going to allocate, the partner is going to allocate your entire outside basis to those assets that are being distributed, okay? And you can increase, because your outside basis is bigger than the inside basis of what's being distributed, right? So you can increase the basis of any other property, not hot assets. You cannot increase the basis of hot assets, okay? And the reason for that is if you increased the basis of those hot assets, then that would distort the amount of ordinary gain that you would recognize potentially upon the sale of those hot assets, okay? If you could increase the basis of those hot assets, then you could change the amount of gain that you would have to recognize a year from now when you sell those hot assets, okay? So, but remember, you're not going to recognize any gain or loss even though you're redistributing basis, okay? So those are the big ticket items for scenario 2, okay? This is how you would actually go about assigning those the basis to those assets, okay? And again, there's an example that is stepped through in the Canvas PowerPoints. All right. Now, scenario 3, okay? Outside basis is less than the inside basis of the distributed assets, okay? So now you've got an outside basis of 100, okay? And you're distributing, let's say, something with a basis of 150, okay? But you're only distributing money in scenario 3, okay? Now here in scenario 3, it says same tax consequences as in operating distributions of only money, okay? So think back to when we were talking about the operating distributions, and remember that generally, right, we said you don't recognize a gain or loss on distributions of money from an operating distribution. However, right, if the distribution is greater than the partner's outside basis, you're going to recognize gain in this case. So in this situation, you would recognize gain. So your distributed assets are 150. Your outside basis is 100. So your gain would be $50 in this situation, okay? Scenario 4, instead of just distributing money, you're distributing money, inventory, and or unrealized receivables. So what does that mean? You're distributing money and hot assets, okay? So you're going to reduce the basis in those distributed assets, not the money, okay? Just the distributed assets. So those hot assets are going to have a reduced basis, okay? But you're not going to have to recognize any gain or loss. For just a second. So for scenario 4, you should know that scenario 4 involves a distribution of money, inventory, and or unrealized receivables. So that means money and hot assets. And you should know that you're going to have to reduce the basis of those hot assets, but you're not going to recognize any gain, okay? All right, this slide shows you how to actually do that calculation. You will not have to actually do that calculation on the exam. You should know the outline of those 5 scenarios, what they each mean, and I'm going to go back to the previous slide. I've included the calculations for how you would decrease those bases, but you will not have to do that calculation. The last scenario is scenario 5. And so here is the kicker here. The terminating partner does not recognize gain or loss, but decreases basis in the property, okay? And so we're similar to scenario 4, except here you reduce basis in other property, not the hot assets, okay? So again, we're not going to go into the details of the calculations for these, but it's important to understand the nuts and bolts of the different categories. So the other thing that we need to cover in this chapter are what are called special basis adjustments. And so these help eliminate the discrepancies between the inside and outside bases and correct artificial income or loss at the partnership level. Okay, so why do these things occur? Why do these discrepancies occur? Well, we have two situations, right? So following the sale of partnership interest, right? We've already talked about all of these scenarios, the liquidating distributions, where you have to reallocate the basis of assets, okay? And then following distributions, when the basis of distributed property is increased or decreased, and when the distributing partner recognizes a gain or loss, okay? So you've got, these are liquidating, and these are operating, right? And so you've got situations where now you have these discrepancies in basis, okay? And so as a result, we have some special basis adjustment allowances and procedures, all right? So the partnership, so this happens at the partnership level, and they make a Section 754 election, okay? And essentially, what this allows them to do is they make special basis adjustments when there are sales of partnership interests. So you make this election first, and then subsequently, you're going to make special basis adjustments during sales of partnership interests and during partnership distributions. All right. Additionally, even without this Section 754 election, you have two cases where you have to make these special basis adjustments. Okay. And so I'm going to rearrange and we're going to talk a little bit more specifically here. All right. So we've got special basis adjustments for dispositions, okay? So essentially, the special basis adjustment the partnership makes when a partner sells his or her partnership interest is designed to give the new partner, the new investor, an inside basis in the partnership assets equal to their outside basis, okay? So the whole purpose okay, so the purpose is then for that new investor, okay? It's important to know too that for the continuing partners, their inside basis will remain unchanged. Oops. And so these are called the continuing partners. not up. And this is important because their share of income and losses will still be correctly allocated. Okay. Now you may be wondering what this adjustment is equal to. So let's do that. So the adjustment is equal to the difference between the new investor's outside basis and share of inside basis. Okay? So, and remember that generally, the new investors outside basis is the cost of the partnership interest plus share of the partnership liabilities. Okay. And then if you have to make that special basis adjustment, okay? So when a new investor's special basis adjustment is allocated to depreciable or amortizable the new investor will actually benefit from additional depreciation or amortization. From additional depreciation, amortization. So, kind of a cool feature. All right, so that Section 754 election it actually has two different pieces, okay? And so Section 743B authorizes adjustment for dispositions, and then Section 755 determines the allocation of the adjustment, and then 734 authorizes the adjustment for distributions. Remember, dispositions would be a sale, right? Distributions are different. And then, again, Section 755 determines the allocation for the adjustment. Okay, remember that this is a problem when the partnership distributes property to the partners and the basis of the distributed property is changed, right? And so this is also going to affect the common basis of the partnership property, not merely one partner's basis. Okay, so if you have a positive basis adjustment, all right, it's going to increase the basis in the partnership assets. Okay. In partnership assets. All right. And so essentially this happens two different times. When the partner receiving distributed property recognizes a gain on the distribution, and when the partner receiving the property takes a basis in the property less than the partnership's basis in the property. Less than the partnership's basis in the property. Okay, so that's when you're going to have a positive basis adjustment. Okay, so those are the positive basis adjustments. Now, what about a negative basis adjustment? I'm going to slide up here. Whoop. All right. So a negative basis adjustment decreases the basis in partnership assets. Okay, and so as you can imagine, these occur when the partner receiving property recognizes a loss and got to slide up there. When the partner receiving distributed property takes a basis greater than the partnership's basis. In the property. Okay? All right, so that completes chapter 10. Again, focus on operating distributions as opposed to calculating liquidating distributions, but like when would a negative basis adjustment occur? Those are things that you should hone in on as well. All right, that completes chapter 10.